You know, usually when we picture a bank robbery, there's a very specific, almost like cinematic image that pops into your head.
Oh, yeah, the classic Hollywood heist.
Right. You've got the ski masks, the getaway car idling in some dark alley, maybe some dramatic sparks flying off a vault being cracked open at midnight.
But today, I mean, the most devastating bank robberies don't involve a single physical weapon.
No getaway driver required.
Exactly. They just involve silent lines of malicious code, usually deployed from a laptop halfway across the world. The modern bank heist is completely invisible to the naked eye, at least until the moment the damage is already done.
Yeah, and the scale of that damage is just, it completely dwarfs anything you could physically carry out in a duffel bag.
Oh, absolutely.
And that scale is actually terrifying when you look at the historical data from the sources we're diving into today. Like, take the 2012 attacks as a baseline.
Right, the coordinated DDoS attacks.
Exactly. A massive distributed denial of service attack. And for anyone unfamiliar with the mechanics of that, a DDoS attack isn't a surgical strike. It's basically a massive digital traffic jam.
Yeah, it's brute force.
Right. Hackers hijacked tens of thousands of compromised computers, like a botnet, and forced them to just flood the servers of 6 major American banks simultaneously with fake requests.
We are talking about massive institutions here, right?
Huge. Bank of America, JP Morgan Chase, Wells Fargo. And their servers literally collapsed under the weight of the traffic. I mean, millions of people suddenly couldn't access their accounts. They couldn't check their balances or, pay their mortgages.
And the crazy part is that was over a decade ago, which in cybersecurity terms is, well, practically ancient history.
Right.
The sophistication of these operations has just accelerated exponentially since then. I mean, look at the 2024 incident where an anonymous hacker group successfully breached 20 Iranian banks.
Oh, man. Yeah, that one was wild.
It was. And this wasn't just a disruption of service like the 2012 attack. This was data extraction. They gained unauthorized access to millions of personal accounts and credit card details.
And didn't the banks have to pay out?
Yeah, they reportedly had to pay millions in ransom just to prevent all that sensitive financial data from being dumped onto the public internet.
Which really makes you wonder how safe our money actually is when, the vault is just a server farm somewhere.
Exactly.
Which brings us to our mission for this deep dive. We are looking at a really comprehensive 2026 academic paper published in the Journal of International Business Studies.
Right, titled Banking System Stability, a Global Analysis of Cybercrime Laws.
Yeah. And we're asking one central, almost philosophical question here. Can a piece of legislation, literally just words passed in a parliament or a Congress somewhere, actually stop a hacker and keep your money safe?
It's a phenomenal question to explore, honestly. And what the study does is take a massive data set. I mean, we're looking at an analysis spanning 132 countries, over 20,000 individual banks, and 3 decades of empirical data.
Wow.
Yeah, it attempts to map out this hidden legal web that protects our global financial system. And to really ground the stakes for you, the listener, there is a sobering quote in the paper from Jonah Force Hill.
He's the executive director of the U.S. Secret Service Cyber Investigations Advisory Board, right?
That's the one. He points out that while virtually all sectors of the global economy fall victim to cybercrime, absolutely no sector is more regularly, relentlessly targeted than the financial sector.
Well, because that's where the money is.
Exactly. Willie Sutton was right.
So if the threat is that massive and that persistent, let's talk about the global response.
Yeah.
Are anti-hacking laws actually moving the needle on keeping banks stable? Or is, a cybercrime law just political theater to make the public feel better?
Well, the data paints a surprisingly optimistic picture, but looking at the sheer scale of the global legislative response kind of sets the stage here. According to the United Nations data cited in the study, as of 2021, 80% of countries globally have enacted some form of specific cybercrime legislation.
Wait, I have to jump in here because there is a historical nugget in this data that absolutely blew my mind.
Oh, the Costa Rica thing.
Yes. When you think of the very first cybercrime law, you naturally assume it was drafted in the U.S. or maybe Europe in the late 90s, right at the dawn of the commercial internet.
Sure, that makes intuitive sense.
But Costa Rica was actually the first country to enact a cybercrime law way back in 1970.
Which is just incredible legislative foresight when you think about it. I mean, in 1970, commercial banking was still running on room-sized mainframes and punch cards.
Right.
But Costa Rican lawmakers recognized early on that telecommunications and electronic data manipulation posed a future threat. They were essentially writing the foundational legal framework for data tampering before the personal computer even existed.
It shows that someone realized really early on that digital information has tangible value.
Exactly.
But moving from that first law in 1970 to the 80% global adoption rate we see today, the study delivers this primary, undeniable conclusion. Cybercrime laws fundamentally make banks safer.
They do. The numbers back it up.
Okay, let's unpack this.
Yeah.
Because safer is a pretty vague word. In the realm of global finance, we need to know what that actually looks like in the hard numbers.
Right. So the researchers approached this by measuring bank stability using a few established economic metrics. Primarily, they used the Z-score and CISC.
Z-score and Z-score, got it.
Yeah, and the Z-score is fascinating because it's not just academic jargon. It is a literal measure of distance. It basically calculates how many standard deviations a bank's returns would have to fall before the bank becomes completely insolvent.
Oh, okay. So it's basically a measure of their buffer.
Exactly. It's their safety cushion. And S-risk, on the other hand, measures the expected capital shortfall a bank would experience during a severe global financial crisis.
So they are essentially stress testing the bank's breaking point using historical data.
That's exactly it. And when they ran the numbers comparing banks before and after the respective countries enacted cybercrime laws, they found that an individual bank's stability, like its Z-score buffer, increases by nearly 0.7%.
Which, I mean, that might sound like a rounding error to a casual observer.
Yeah, less than 1% sounds small.
But in the banking world, a 0.7% increase in baseline stability across thousands of daily transactions is a massive multi-billion-dollar cushion.
Oh, it's huge. And the individual bump is significant. But the real shocker emerges when you zoom out.
What do you mean?
When the researchers analyze the stability of the entire banking system, meaning that complex, interconnected web of all the banks operating within a country, the systemic stability jumps by over 25%.
Over 25%? Wait, really?
Yeah, 25%.
That is wild. Think of cybercrime laws not just as a do not enter sign for hackers, but as an invisible global immune system for the economy.
I like that analogy.
It's not just protecting one isolated cell. It is fortifying the entire body.
Exactly, because systemic risk is entirely about the domino effect.
Yeah.
If one mid-sized bank gets hacked and suffers a catastrophic loss of capital, the danger isn't just to that specific bank.
Right, because they all owe each other money.
Exactly. The danger is that they default on their obligations to larger banks, which then freeze lending, causing a cascade that takes the whole system down. These laws act as a massive buffer against that initial domino falling.
Okay, it makes total sense on a macro level.
Yeah.
But bridging the gap between a piece of paper signed by a politician and the actual day-to-day mechanics of banking is the tricky part, I think.
How so?
Well, how does a law actually alter reality? Because the hacker sitting in a basement halfway across the world definitely does not care about a foreign statute.
Right, the hacker might not care, but the people who hold the money certainly do. The study identifies two primary channels through which these laws fundamentally alter behavior within the financial ecosystem.
Okay, what's the first one?
The first is what they term the funding liquidity channel.
Funding liquidity is fascinating here because in the digital age, a bank run doesn't look like that classic scene from It's a Wonderful Life, with a huge line of panicked people wrapping down the block demanding physical cash.
No, not at all.
A modern bank run looks like millions of customers tapping transfer on their banking apps at the exact same second, just because they heard a rumor on social media.
And that speed makes trust the absolute most valuable currency a bank has. When a country passes strict, highly publicized cyber laws, consumer trust naturally elevates.
Okay, I see.
The public perceives that the government is actively policing the digital frontier and that there are established legal frameworks to prosecute theft and recover assets. Because of that quantifiable trust, people feel secure keeping their deposits in the bank rather than, moving them to alternative assets or offshore accounts.
Which connects directly to you listening to this right now. If you constantly felt like your digital checking account was just one malicious click away from being drained, and you knew the police had literally no legal authority to investigate it, you wouldn't keep your savings there.
You'd put it in a mattress.
Exactly. But when you feel your data is legally protected, your money stays put. That gives the bank a larger, more stable pool of capital, which is the liquidity, which stabilizes their lending operations and the broader economy. You are essentially funding the bank's stability with your trust.
That's a great way to put it. And the data supports that direct correlation. The second mechanism the researchers detail is the operational risk channel. This is where we see the bank's internal architecture change.
Okay, so if the laws are the immune system, this channel feels like the white blood cells. It's the active daily defense.
That analogy holds up perfectly, because a cybercrime law does not just punish the criminal after the fact, it establishes a rigorous standard for the potential victims.
The banks themselves.
Exactly. To comply with the evolving legal landscape and cooperate with law enforcement, banks are forced to mature their internal operations. They have to implement stricter security protocols, conduct mandatory third-party audits, and aggressively train their employees to recognize social engineering tactics like phishing.
Because no matter how advanced your firewall is, human error is perpetually the weakest link in the chain.
Okay.
I mean, all it takes is one exhausted employee clicking on a fake invoice email.
We see it all the time. By legally pressuring banks to adopt these proactive measures, the legislation drastically reduces daily operational risks. We're talking about mitigating the costly system outages, the minor internal data leaks, and the technical failures that quietly hemorrhage capital and erode client confidence over time.
Okay, but I have to push back here because this brings up a massive logical challenge that I know economists love to debate.
Oh, what's that?
It's the moral hazard question.
Ah.
Right. If the government suddenly steps in, assumes the role of the digital police force,
Yeah.
and actively hunts down hackers using taxpayer dollars, wouldn't banks naturally get a little lazy?
It's a fair question.
It's like having incredibly comprehensive, zero-deductible car insurance. Maybe you drive a little more recklessly because you know any damage is fully covered. If the government is providing the shield, why would a bank voluntarily spend hundreds of millions of dollars on its own IT security?
What's fascinating here is that the researchers actually anticipated that exact behavioral quirk.
Mm-hmm.
Moral hazard is a powerful force in financial markets.
Oh, absolutely.
If banks felt overly insulated by the mere existence of a state-sponsored cyber task force, the rational economic move would be to underfund their own cybersecurity departments to maximize quarterly profits.
Which would ironically make the entire system significantly more vulnerable.
Exactly. But the empirical data proves this doesn't happen.
Wait, really? So what breaks that cycle of laziness?
The nature of the legislation itself.
Yeah.
These laws function as mandates, not just safety nets. If we go back to your immune system metaphor, the laws act like a vaccine. They force the body to build its own antibodies.
Oh, I see.
The legal frameworks generally require banks to implement and maintain specific, rigorous cybersecurity standards as a condition of operating.
So the government's stance is essentially, we will hunt down the hacker, but you are legally obligated to have a vault with a 6-foot steel door. If you leave the back door open, we are coming after you too.
That's a perfect summary. That dual pressure completely eliminates the moral hazard and keeps the institutions highly vigilant.
Wow. Okay, so the data clearly shows these laws work by increasing consumer trust and forcing internal operational discipline. But that naturally leads to comparing different countries. I mean, you look at the global map and legal systems vary wildly in their design and execution.
Oh, drastically.
Right, a law drafted in Singapore looks very different from one drafted in Brazil. How did the researchers figure out what actually makes one country's cybercrime law more effective than another's?
They conducted a really deep cross-sectional analysis across the 132 countries to identify the specific variables that act as multipliers for success. It turns out that the actual architecture of the law dictates its impact.
And what were the main multipliers? I imagine the most intuitive factor they found is the severity of the punishment. Like, prison sentences alter the basic cost-benefit analysis for a hacker.
Yes, basic deterrence theory at work. The study quantified that laws carrying heavier maximum prison sentences serve as a demonstrably stronger deterrent.
Makes sense.
When the perceived personal cost of executing a cyber attack increases from a slap on the wrist to, say, decades in a federal penitentiary, the frequency of attacks against institutions in that jurisdiction drops, and that leads to measurable gains in the Z-score stability we discussed earlier.
But I imagine a massive loophole here is geography, right?
What do you mean?
Well, the internet is inherently borderless. If I am a hacker, I'm probably not sitting in a coffee shop in the same country as the bank I'm targeting. I'm routing my attack through servers in 3 different countries to rob a bank in London while sitting in Eastern Europe. A harsh prison sentence in the UK doesn't scare me if the UK police literally can't touch me.
That geographical loophole is exactly why the researchers identified bilateral extradition treaties as a critical multiplier.
Ah, extradition treaties.
Right. The jurisdiction of the law has to match the reach of the internet. A domestic cybercrime law basically loses its teeth internationally if the host country cannot compel foreign governments to hand over the suspects.
So the treaties introduce friction. A hacker might be safe in their living room today, but they can never travel, they have to constantly hide their digital footprint, and they completely lose the psychological safety of assuming borders will protect them.
Exactly. The data shows that when countries have robust networks of extradition treaties, the stabilizing effect of their domestic cyber laws is magnified significantly. It effectively globalizes their legal deterrent.
That makes total sense. But even with a global deterrent, treaties don't matter much if the bank itself is reckless with your data. Which brings up the variable that I found to be the most compelling. Here's where it gets really interesting. Bank accountability.
Yes, this is huge.
We touched on this with the moral hazard concept. But the study shows the most effective legal frameworks are the ones that impose massive, crippling financial penalties on the banks themselves when a breach occurs.
And I know it feels counterintuitive to penalize the victim. I mean, the bank was the one that got hacked, right?
Right.
But fining the institution is the ultimate mechanism for aligning incentives.
It completely shifts the boardroom conversation. Cybersecurity is no longer viewed as a frustrating IT expense. It becomes a core business survival metric.
Yes. When executives know that a data breach won't just result in a temporary dip in public relations, but will trigger an immediate multi-million-dollar regulatory fine that could threaten their operating license, their behavior changes overnight.
I bet.
They prioritize defense architecture above almost everything else. The law leverages the bank's own profit motive to protect the consumer's data.
It's brilliant. But, all of these mechanisms, extradition treaties, corporate fines, prison sentences, they all assume one foundational thing, don't they?
Right.
A functional court system.
Oh, absolutely.
You can draft the most comprehensive, technologically advanced cyber penalty in the world. But if the local judicial system is bogged down by corruption, extreme inefficiency, or, frankly, just lacks the technical expertise to prosecute complex code, that law is just a decorative piece of paper.
The foundational layer holding all of this together is the rule of law. And the researchers found a stark contrast in the data. Countries with a strong, culturally and institutionally respected tradition of enforcing their laws see the most dramatic boosts in bank stability.
Because everyone knows it's not a bluff.
Exactly. The legal apparatus must be robust enough to follow through on the threats the legislation makes. When both the hacking syndicates and the banking executives believe that violations will be swiftly and fairly penalized, the entire ecosystem stabilizes.
So what does this all mean? We've journeyed through Z-scores, digital bank runs, the mechanics of international extradition, and the boardrooms of global banks.
It's been quite the tour.
It really has. But let's bring it all home to you, the listener. Every single time you swipe a credit card to buy a coffee, every time you casually check your balance on your app while waiting for a train, or deposit a paycheck using your phone's camera, you are relying on something completely invisible.
Something most of us never even think about.
Right. You are relying on a massive, intricately woven web of legal deterrence, international treaties, and enforced corporate accountability. The safety of your money today is no longer about the physical cash sitting in a giant steel vault downtown. It is entirely dependent on the legal architecture governing the digital space where your money actually lives.
It is a profound paradigm shift in how we conceptualize financial security. And, if we connect this to the bigger picture, it leaves us with a truly urgent question for the future.
What's that?
Well, this massive academic study proves that historically over the last 3 decades, these legislative frameworks have worked beautifully for traditional commercial banks defending against traditional profit-driven cybercriminals.
Right. The system works for the threats it was built for.
Exactly. But technology refuses to sit still. We are currently watching the rapid expansion of decentralized finance, where there often isn't even a central banking entity to regulate or protect.
Oh, true. Crypto and DeFi are a whole different beast.
Right. We are witnessing the dawn of AI-driven hacking programs that can identify vulnerabilities and adapt to security patches in milliseconds, far faster than any human IT team.
That's terrifying.
And most concerningly, we're seeing a rise in state-sponsored cyber warfare, where the hackers have the limitless funding and the full legal protection of a rival government.
Because a foreign military intelligence unit attempting to destabilize a currency doesn't care about a bilateral extradition treaty or a corporate fine.
They don't.
Okay.
So the provocative thought we have to mull over is this. Are our current localized legal frameworks, which rely on slow legislative debates and geographic boundaries, agile enough to protect the banking systems of tomorrow? Or is the very nature of passing laws destined to always remain one step behind the artificial intelligence and state actors who move at the speed of light?
It's a chilling thought to leave on. I mean, we started this deep dive by picturing that classic Hollywood bank robbery, the ski masks, the vault, the getaway cars. We successfully replaced that image with silent lines of code.
Yeah.
But if those lines of code are now being written by autonomous AI or deployed as weapons by nation-states, the rules of the heist have changed all over again. That invisible global immune system we have spent decades building might be due for a very serious software update.